Good morning. It is 5:25 in the morning, live at 5:25. Are you paying taxes? It's my hook, okay? Are you paying taxes? Are you paying taxes? Do you pay taxes? Most people pay taxes. I don't know how much taxes ex-President Trump paid, but I know he paid a little bit, but there was something that he paid. So if you are paying taxes, if you and I are paying taxes, there is something that we are not doing right. Why? Because the IRS tax code gives us the exact formula. I know it's kind of early in the morning to be talking about taxes. I don't know where you are in the world going to be watching this from, but there's a specific formula to avoid paying taxes, to pay zero taxes. Legally, the formula, the tax formula, the IRS formula tells us how not to pay taxes. So paying taxes in the past, we have to do for previous year because there's nothing we can do about that unless you amend. But paying taxes in the future, there's something to be done about that. We do not have to pay taxes. So my name is Michael Wander. I'm a CPA based out of Los Angeles. My focus is in real estate. And hey, Nefeli, what's going on? Miss Sparks, up so early. Yes, taxes in the morning. So I focus on real estate, and so what is it about real estate? Now, specifically, yesterday I put out a quick video about my services, about niching down in my services. And so the specific services that I have focused on, right, specific area is you have, right, if you think of your life, yourself as this pot or a jug of, you have a certain amount of wealth. Now, that jug, that bucket is going to have money coming in and it's going to have money coming out, or expenses, right? Income and expenses. Now, taxes, right? So what I'm focusing on is those two aspects, money coming in and money going out. Specifically right now in this video, I'm going to be speaking about the money going out portion, money going out is taxes. Taxes are one of our biggest expenses. So, morning, Dorothy. Taxes are one of our biggest expenses, right? So through real estate and through understanding the IRS tax code, we are able to reduce our taxes and even eliminate our taxes completely. So we're able to control the outflow of our wealth, of our money. So that is sort of the big picture. Now, now specifically within taxation, there is one aspect that is critical, that is the biggest way that somebody can save on their taxes, and that is through depreciation. Yes, depreciation. Depreciation is a way to, for those of you who just really brief definition, it's a way that we can take a paper loss. We take a paper loss, which is a loss on paper, which shows us that we have a loss, right? It shows us we have a loss, but it's not an actual economic loss, right? We're depreciating the value of a property. We're going to go into more specific definitions. Now, every time I put on a video regarding taxes, I have my disclosure here. It says, whenever I'm discussing tax concepts, nothing that I say in this video should be construed as legal or financial advice. I provide this information for educational and entertainment purposes only, and you should always consult with your own attorney or with your own tax advisor before making any financial decisions. And last, the views I express in this video are mine and mine alone and nobody else's. Okay, fine. That being said, let's dig in really quickly. So here we go. Taxes, right? So also, by the way, if you know somebody who could benefit, who either enjoys real estate or invests in real estate or wants to invest in real estate, please share this video with them. Hit the like button, comment below. I'm going to be posting this. This is right now live on Facebook. I'm going to be posting this also on YouTube. I'm going to drop the link to my YouTube channel below. I'd love it if you would subscribe as well. Subscribe if you're watching on YouTube. Please subscribe. Drop a comment if you have any questions below. And let us get into it. So to the degree, lastly, right, to the degree that we are paying taxes, obviously this is a very obvious point, to the degree we're paying taxes, that is the degree that we will not have that money to deploy elsewhere, right? So that's just an obvious idea. Now I'm going to dig into the depreciation, right? So I'm going through IRS Publication 946, right? So that is the IRS Depreciation Notification, publication. So first I'm going to describe depreciation. Depreciation, it's an annual deduction. This is from the IRS website. It's an annual deduction, I'm paraphrasing, that allows the taxpayer, allows us to recover the cost or other basis of certain property over the time you use the property. So basically, it's an allowance for the wear and tear, deterioration, or obsolescence of the property. That's the description. Definition. So what we're going to go over in this video, in this section right now, is going to be what property can be depreciated. There are about 8 points that this chapter in the IRS publication goes through. We're going to go over one of those points right now, which is specifically what property can be depreciated. So most tangible property, except for land cannot be depreciated, but most tangible property such as buildings, machinery, vehicles, furniture, and equipment can be depreciated. Also intangible property such as patents, copyrights, and software can be depreciated as well. So now, if you've heard of a cost segregation study, that is basically a way to break out various components of, let's say, a building that are depreciated at different rates. We're not going to go into cost segregation studies right here, but the idea is that you're depreciating, that we get to depreciate different items within a building at different rates, at faster rates, which allows higher depreciation and saving more money in earlier on. So in order to be depreciable, there's these following requirements. There's a requirement that you own the property. Right? Now, if you have a mortgage on a property, it's still considered as though you owned it, right? You make a down payment on a property, it's still as though you own the property and you are able to depreciate it. Now, I'm going to speak a little bit about leased property. Somebody leases a vehicle for work, for example. So both from the lessee side, the one who is leasing, as well as the lessor side, the one who is leasing it out to somebody, to the lessee. So just briefly, the leased property under certain circumstances can be depreciated, right? If you lease property, generally speaking, when the lessor is able to lease the property, to depreciate the property because they own the property. It's called the incidence of ownership. Whoever maintains the incidence of ownership is able, I know it's getting technical, it's getting legal, it's getting a little bit of the jargon, but you don't need to understand I'm not looking for, you don't need to understand everything and remember everything, but just to be familiar with these concepts so you can do your own research. When you're speaking with a tax accountant, you can bring up these ideas and see if they're able to help you with it. And it's good to monitor closely whoever is doing your taxes so you know that they are doing the best job possible and getting you the best return, reducing your taxes as much as legally possible. So, incidence of ownership, right? Incidence of ownership. Whoever maintains the incidence of ownership, they are able to depreciate the property. Now, what are the incidents of ownership? Legal title to the property. I'm going to tell you the brief incidents of ownership, then I'm going to tell you a few scenarios or how that actually plays out in practicality. So if maintains legal title to the property, legal obligation to pay for the property, the responsibility to pay maintenance and operating expenses, and the duty to pay taxes on the property. And this last one is important, the risk, whoever maintains the risk of loss if the property is destroyed, condemned, or diminished in value through obsolescence or exhaustion. So not if the property is destroyed. Wait a minute, actually it does say destroyed. No, if it's destroyed through obsolescence or exhaustion, right? So not through an accident, right? Because why? Because insurance companies insurance companies they have a duty to pay for that loss, right? They maintain the risk of that loss. So insurance companies are not going to be depreciating your property, right? So if it's decreased in value through obsolescence or exhaustion, those are the incidents of ownership. So now, generally, if you lease the property, as we said, if you are leasing the property, you cannot depreciate it. However, let's say you make capital improvements to the property, right? Let's say you lease a property and you make capital improvements to the property, you can depreciate those capital improvements. That's one thing. So now, if you are leasing the property to somebody else, right? If you're leasing the property out to somebody else, then you generally can depreciate the cost, even if the lessee agrees. Mr. Greenberg, Lee Greenberg, good morning. Up early. So we're talking about depreciation. If you lease the property, right? We're talking about leasing. Can you depreciate a property if you are leasing the property or if you are leasing it out to somebody else? If you are the lessee or the lessor. So the lessor can generally depreciate the property even if the lessee agrees to, listen to these words, to preserve, replace, renew, and maintain the property. So if the lessee even if the lessee agrees to do those things, the lessor is still able to depreciate the property. However, big however right here, if the lease provides, right, if it is stipulated inside of the lease that the lessee is going to maintain the property and return to you, the lessor, the same property, right, or its equivalent in value at lease expiration in as good of condition as when they leased it out, then the lessor cannot depreciate the property. So that was a mouthful right there. That was a handful. So I'm going to break it down really quickly into ways that, into an easier way for myself and for you guys. So basically, right, so the bottom line is that if the lessee is replacing the property, is maintaining the property for themselves, then the lessor can still depreciate the property, But if in the contract it stipulates that the lessee is going to replace it and give it back to you in that same good condition or equivalent, then the lessor cannot depreciate it, right? Because then basically who has the incident of ownership, right? Who is maintaining the risk of loss? It is going to be the lessee in that scenario, because it's in the contract. It's in the contract that the lessee is going to be giving it back to you in that condition. So bottom line is, if you are leasing a property yourself, generally, leasing a vehicle, generally you're not going to be depreciating it unless you are giving it back. Good morning. Unless you're giving it back in the same condition. But if you are leasing the property out, then think about these items right here about how to structure the contract to make sure that you are still able to depreciate it. Now, a few more items. We're discussing what property can be depreciated. So we mentioned that the property must be owned by you. Now, another item is it has to be used in your business, right? Personal property cannot be depreciated, meaning property that is for your own personal use, not for business use. So it has to be used. Property has to be for business use in order for it to be depreciated. And again, if you're using it partially for partial personal and partial business use, then to the degree that it's used for business purposes, it can be depreciated. So includes a home office, right? If you own your home and you have a home office, to the degree you can depreciate that portion of your home office. That's awesome. That's amazing. Your home office. Everybody has a home office nowadays with COVID, right? So your home office, you can depreciate part of your home. That's amazing. Okay. Now, what else? Inventory cannot be depreciated. Something that's held for sale to the customers in the ordinary course of business cannot be depreciated. There may be some exceptions if you're a rent-to-own dealer. Not going to go into here, mainly because we're not going to go into it here. But What else? Determinable. So there are two more criteria to determine what property can be depreciated. These are brief. It has to have a useful life. It has to have a determinable useful life, right? You have to know what period of time the asset, the property, can be depreciated over. Is it 27 and a half years for buildings, for example? Is it 5 years? What is it? So it has to have, what is the useful life? You have to have a useful life. It's over the time period that it wears out, that it decays, that it gets used up, becomes obsolete or loses its value from natural causes. And the last point that tells us what property can be depreciated per the IRS Publication 946 is it has to be expected to last more than 1 year. For example, the example given is you have a library for your profession. You can depreciate it because it's expected to last more than 1 year. However, if you purchase technical books, journals, etc., right, those are going to be expensed in the period incurred, not depreciated. Depreciated, it means more than 1 year. That in a nutshell. Again, I want to thank you guys for coming on so early in the morning and watching and showing your support. Appreciate it, really appreciate it. Please, if this was of any value to you, please like it below. Share this with your network if you think anybody can get some value from it. Anybody interested in, again, this is I work with mainly with real estate, but depreciation is applicable beyond real estate. So if you know anybody that can benefit from depreciation, who has their own business, is an entrepreneur, or who has real estate and or is interested in real estate, please share this video with them. Like and comment below. And if you're watching this on Facebook, thanks for coming live. If you're watching it on YouTube, please subscribe to the channel. If you want to, I'm going to be going through the publication for depreciation. Again, Michael Wander, CPA. I'm going to be working through the taxes, through what are the best strategies to decrease your taxes legally, and then we're going to be going over at a different time. And so this series is going to be specifically with regards to depreciation. At a different time, we're also going to go through the strategy to some strategies to increase your income through real estate. Michael Wander, CPA, my contact information, I'll drop it below. You can shoot me an email if you have any questions. Drop any comments in the comment section, any questions, and I will do my best. I will respond. I'll respond. Have a great day, a great Thursday. Today's Thursday. Roth IRAs, Leigh Greenberg is the Roth IRA guy. He's got Roth IRAs. If you need a Roth IRA, reach out to him. He's in the comments below. Have a great day. Bye-bye.